Okay, in this example, we have a company that plans on producing 5,000 units. And with that, this is what their pro forma income statement looks like. In other words, sales minus your variable cost equals your contribution margin minus your fixed cost equals your operating income. Now, this question is asking what would our operating income be if sales increased by 10%? And this idea is the same idea behind preparing a flexible budget. Basically, what happens is you do your master budget, and then at the end of the period, you find out that you've sold more or less than the planned. And so what you do is you figure out, okay, based on the actual quantity that we produce versus what we planned on producing, what should our costs have been? And then you compare it to the actuals. So in this case, we're asked what about operating income if sales increase by 10%. Well, an increase in sales by 10% means that the sales would be 10% higher. Well, 10% of 5,000 is 500. Or another way you do these is you take your units and multiply it by 100 plus the increase, so 110%. And that will be our quantity of our units of sales. So up here, I'm going to make this 5,500 units. Now these are units. Some problems, if you're a service company, these may be in hours. It depends. All right, so what should our operating income be if we have this increase? Well, all I need to do is work for my contribution margin on down, because the sales minus variable costs, this is going to be basically the same amount per unit. So I'm going to do it per unit. And I'm going straight to here, and if I had total contribution margins of 30,000, selling 5,000 units, then my contribution margin is $6 per unit. Whenever you use Excel, you should make sure that you have enough decimal places. In other words, it rounds automatically. So to increase your decimals, you go home and then you go to the format, and this increases it and this decreases it. Anyway, $6 is what I have here. So given that I produced or sold 5,500, I would take the contribution margin per unit times the 5,500 units. So at a 10% increase in sales, I should have essentially 10% increase in my contribution margin. Fixed costs are fixed. So your operating income is equal to your contribution margin minus your fixed costs. So we would have a $3,000 increase